Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at e.l.f. or e.l.f. Beauty Inc. e.l.f. is a cosmetic company. The e.l.f. cosmetic category primarily consists of face makeup, eye makeup, lip products, nail products, and cosmetics sets and kits. Here's the barchart.com technical opinion rating for e.l.f. The bar chart rating is a 100% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis. If the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that e.l.f. is well above the moving average line, so the monthly trend in e.l.f. is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line crossed back above and stayed above the green line in November, so the daily trend in e.l.f. is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. e.l.f. is below the upper Keltner channel line, so e.l.f. is inside the buy zone. Since the trend is up, we want to buy a call. e.l.f. has plenty of option chains to choose from. We're going to use the April 19 option chain. Right now, the April 19 options have 26 days to expiration. Here's most of the e.l.f. option chain for April 19. e.l.f. closed at 205.60 on Friday. That means any calls on the list from 145 to 205 are in the money. Let's take a look at the profit potential for purchasing the 205 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 205 call is 1210 to 1260. We tried to enter at the midpoint, so we'll use 1235 as the buy price. Our call option calculator shows the profit potential for this call based on e.l.f. price changes at option expiration from flat to a 12.5% increase in price. We can see that if the e.l.f. stock price is flat at 205.60 at option expiration, the 205 call will lose 95.1% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 185 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 185 call. According to the 1% rule, we want to call to at least break even if the stock price is up 1%. The calculator picture shows that if the e.l.f. stock price is up 1%, the 185 call will lose 10.1% of its value. We want that to be break even or better, so the 185 call does not meet our requirements. Let's see if the 165 call will work. The bid-ask spread for the 165 call is 40.50 to 43.40. We tried to enter at the midpoint, so we'll use 41.95 as the buy price. The 165 call works. If the e.l.f. stock price is up 1%, the 165 call will make a 1.7% or $71 profit. That's better than break even, so the 165 call is the one we'll buy. The call option purchase calculator also shows that if the e.l.f. stock price increases by 2.5%, the 165 call will make a 9% or $379 profit. If the e.l.f. stock price increases by 5%, the 165 call will make a 21.3% or $893 profit. If the e.l.f. stock price increases by 7.5%, the 165 call will make a 33.5% or $1,407 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the e.l.f. stock price does not make the expected move up and remains flat at expiration, the 165 call would only lose minus 3.2% or minus $135 compared to the minus 95.1% or minus $1,175 loss for the 205 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the e.l.f. April 19 expiration 180 strike call and sell to open the April 19 190 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 180 call for $29.15 and sell the 190 call for $21.80. $29.15 minus $21.80 equals $7.35. So the entry price or debit cost for the spread is $735. The call option spread analysis calculator picture shows that the spread will make a 36.1% or $265 profit if the e.l.f. stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $2,180 cash credit to our brokerage account for the sale of the 190 call. As we said on the previous slide, this reduces the cost of entering the spread to $735. Here's a note regarding earnings reports. The next e.l.f. earnings report is scheduled for May 7. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the e.l.f. April 19 expiration 165 strike call for $41.95. We also reviewed the spread. The spread said to buy to open the e.l.f. April 19 180 strike call and sell to open the e.l.f. April 19 190 strike call at a debit of $735. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.